Last change is the minimum down payment for rental properties. Okay, so the new minimum down payment is 20%, and it was previously 5%. So someone, if they qualified, had enough income, had enough rental income coming from the property, they could buy it. There was programs available for as little as 5% down. They did have a hefty insurance premium because the deal, of course, was insured, but it could be done. Okay. So if the property was $500,000 before, obviously 25 grand minimum, and there'll be the insurance, but now obviously 20% of 5 is 100, so if they're going to rent it out, they're going to need a much larger down payment. Okay? So this does not apply to second homes. There's a category of non-owner occupied properties which are deemed as second home. So a true second home meaning you cannot count any rental income coming from it in order to qualify for the mortgage. This is not affected by this. You can still buy those. You don't need to put 20% down. But if you need the rental income generated to qualify, you will need 20% down. Okay? And that is it. So the next section here, I'll just turn over to Rowan.
All right, so Maury covered off what a conventional mortgage is, but there's, and all of these changes that apply, we've been talking about high ratio. So the government mandated changes apply to things, the 3 different changes, the investments, the refinance, and the amount of down payment that's required. However, just because that only applies to 80% financing or more, so less than 20% down, there's actually a lot of banks that are going to follow those guidelines all the way down the road. So it doesn't matter if you've got 35, 40, 50% down, a lot of banks are still going to follow these new guidelines. The reason is kind of complicated and involves how the banks raise their money in the markets and whatnot. But if they're going to be doing that, you can see that these changes, and there's a lot of lenders that are going to be following them, I'd say half or more. So it's going to have a lot of impact for any loan to value, even though the mandated change only applies to 20% down or less. So rental income changes. In Vancouver, this is huge because we've heard the percentage of properties, especially condo market, it's rentals. It's definitely the most dramatic change. And ironically, this one isn't even mandated. This is simply something that's come down through CMHC, and then all the other insurers have jumped on board with similar policies, not identical. So we have 3 different insurers we talked about. We're not going to get into the specifics of who does exactly what type of product. But I can say that rental income is treated far less favorably than it was in the past. Now, this includes rental income from multiple different sources. You've seen on purchases, you see mortgage helper, in-law suites, nanny suites, basement suites. It doesn't matter what you call it. If it's a secondary suite within the property that has a second kitchen and is bringing in revenue for that property, then that income is being treated far less favorably than it was. It used to be that you could take a certain percentage of that income, say 80% was the number, and we would go, okay, you've got $1,000 of rent, you've got $800 we're allowed to use, how much mortgage does that support? And the answer was like $180,000 or something. So right away the person qualified for $180,000 more just by virtue of having that suite in the property. Well, in Vancouver we've got the whole authorized, unauthorized suite issue, right? And if something's authorized, can we use it? If it's unauthorized, can we use it? And the answers vary from insurer to insurer. So that's something where the brokers have to know every one of the guidelines and every one of the rules for the different institutions. I want to give an example of how the new rules are going to take effect. We're going to use the same example, $60,000, average cost, clean credit, etc. So this is assuming a $1,000 basement suite, $680 to $515. So the old approval amount. And in Vancouver, I mean, you picture East Vancouver. Almost every home has a basement suite. Picture Surrey, Delta, all these different areas. All these basement suites that we were previously able to bring into the mix, we can, but at a much lesser and more constricted treatment. That's a 24% decline in or reduction in how much somebody can qualify for based on that income. So 24% is going to translate into an effect on how many buyers can afford properties at a particular price. Now rental income, I was talking about suites there, but it comes from multiple sources. There's really 3 different ways. You've got your basement suite, but then you've got a pure rental property. You're living in your home, maybe you have a rental condo, and it's rented out. The third one is for somebody, and this is where this third one is really where the rules are murky, and it's going to be interesting to see how it plays out. When someone owns a home, especially a first-time home buyer, They own their property, they want to upgrade to a new property, but they don't want to sell the first one. Maybe they've been there 5 years, they've built up significant equity, perhaps the property can rent for a considerable amount, so they want to get out of that property and move into a home. In that circumstance, that is where the treatment of that income for the old property is not really clear. The reason being is they don't have it at this point in time. So if somebody has a pure rental property and they've had it for an extended period of time, the new rules actually favor the treatment of that income over all else, as long as the people are declaring it and paying tax on it. If you're not declaring it and paying tax on it, going forward, it'll be far, far harder to qualify. So people should be declaring it anyway, because then you can offset your interest costs on the mortgage. So it makes sense to declare it and bring it into the math, but a lot of people still aren't doing it. Was there any questions on the rental income or how this affects suites, unauthorized, or whatnot? Okay, and that's the rental income section. I'm going to pass over to Leah, who will cover off the self-employed.
All right, so pretty much all of us in this room are self-employed. So you can probably relate to this section. You're probably really anxious to know how this is going to affect you specifically. But definitely in our clients, I know I encounter in Vancouver a lot of self-employed people. And up until now, there has been a program called the Stated Income Program. Now it's exactly that. You're stating your income. And the reason that they have this is because in businesses, if you're a mechanic, you're getting a lot of cash jumps. Like us, we write off our cards, our cell phones, even part of our homes and our rents and our mortgage amounts. So because of that, banks and lenders, the insurers even, they understand there's a bit of a fuzzy gray area. What exactly are you making at the end of the day? Because you have all of these write-offs. So what they've done is they've implemented a program called the Stated Income Program, and they've had this for quite some time. With this, your traditional income verification is not necessary. You don't have to show your T4s. What you're simply doing is just saying, I make $60,000 a year, or whatever seems reasonable. Now with this, it isn't that good to be true, because you are going to have higher premiums with this, which of course is more costs. And you can't just say that you sell coins or you collect bottle caps and you make $100,000 a year. It does have to be reasonable. How do they deem reasonable? Well, there's various amount of things, which kind of leads me into where the changes are. Before, they were a lot more lenient on what was deemed reasonable. Now they're really focusing on different websites and economic studies, and they're going to ask you first, what do you think you make? And then they're going to look at what their stats tell them, and if that seems to fall within their realm, they will deem it reasonable and they will accept it. Now the other change, and again this is only for the Stated Income Program, the down payment amount has changed. It used to be that you could just put down 5%. It is now going to be a minimum of a 10% down payment. It's not to say if you're self-employed you're automatically having to pay 10%. It's only if you decide to use the Stated Income Program. And with that being said, proving your income is always going to obviously stand up stronger with the lenders. So if you are able to, if you're properly declaring how much you make, you're paying taxes on that, keeping in mind if you are self-employed, whatever it shows on your line 150 on your tax returns, you actually get to add 15% of that back to account for write-offs. So if you're able to use proven income instead of stated income, you'll save on your premiums, be able to put a lower down payment down if you like. And as well, like Rowan mentioned, each insurer is a little bit different. And so their internal policies are varying depending on the amount of years you've been in the industry, as well as the amount of years that you've actually been in your own business. So that again is where you're